Imagine, you build a machine that can do the work of 1,000 people.
Okay.
By all logic of business, your profit margins should just completely skyrocket, right?
Right.
And they should stay sky high forever because you have practically eliminated your labor costs.
Right. That would be the assumption.
But according to one of the most controversial and really intensely debated economic texts in human history, inventing that exact machine is the very mechanism that will eventually drive your industry's profit rate straight into the ground.
It is a really profound paradox, honestly. The very engine that drives the system forward, I mean, the technological innovation and breathtaking productivity, is the exact same engine that slowly chokes its ability to generate a profitable return.
And that tension is exactly where we are starting today. So welcome to the deep dive. Our mission today is to unpack a monumental, incredibly dense piece of historical economic theory.
Yeah, we are looking at Karl Marx's Capital, Volume 3. Specifically, we're focusing on the translation and compilation that was published in Volume 37 of the Marx and Engels collected works.
Which is, by literally any measure, a massive and intimidating text.
Oh, absolutely. It's the culmination of an entire worldview.
It is. And right at the top, I just want to establish the framing for our conversation today. Because if you are listening to this, you know we are exploring a text that has obviously shaped global history.
Right. It's triggered revolutions, spawned endless academic wars, you name it.
Exactly. But it's also a text that is deeply misunderstood, I think, often by both its loudest detractors and its most fervent supporters. Like it usually just gets reduced to bumper sticker slogans.
Totally.
So to be crystal clear with you, the listener, we are not here to take a political side today. And we are certainly not here to endorse or condemn the ideology. Our job is simply to act as your guides.
Right. We just want to help you understand these profound, complex, and genuinely surprising ideas exactly as they are laid out in the original source material.
We are looking at the architecture of the argument itself.
And to understand that architecture, you really have to understand the physical and historical reality of how this book even came to exist.
Because he didn't finish it, right?
No, Karl Marx never finished Volume 3. He died in 1883, leaving behind this staggering mountain of rough drafts, scattered notes, heavily revised notebooks.
Just a complete mess.
Oh, absolutely. And incredibly complex, incomplete mathematical calculations.
Like the ultimate messy desk.
Exactly. So it felt his lifelong collaborator, Friedrich Engels, to take on the genuinely Herculean task of compiling and editing all of that. He basically had to decipher those manuscripts into a readable volume.
And this wasn't just a matter of, like, light copy editing.
Not at all.
No, because Marx's handwriting was famously hilariously terrible. I mean, I was looking through the source letters included in this collected works edition, and there is this fantastic, almost painfully relatable detail from 1894.
Oh, the letter to the Russian translator.
Yes. Engels is writing to Nikolai Danielson in St. Petersburg, and Engels is expressing this profound, bone-deep relief at finally sending off the proofs to the printer.
Right, after over a decade of working on it.
Exactly. And he specifically notes that the fifth section of the book, which is the part dealing with credit and banking, took up a whole third of the manuscript. He tells Danielson that this section alone cost him more trouble than all the rest of the book combined.
You can just feel the exhaustion across a century of time. I mean, Engels spent years trying to follow the labyrinth of these financial arguments.
Right.
He was piecing together incomplete sentences and trying to reconstruct the underlying logic of an economic system that was, at that very moment, rapidly evolving.
Which really brings us to the big why. Like, why should you, sitting here today, care about an incredibly dense economic text that was painstakingly pieced together in 1894?
Well, because, as we are going to explore, this text is essentially the origin story of modern global financial systems.
Right. Think of it this way. If you want to understand how a mechanical clock works, you can't just look at the face.
You have to open it up.
Exactly. In Capital Volume 1, the analysis was all about opening the back of the clock and looking at the hidden gears, like the factory floor and the hidden extraction of labor.
And Volume 2 looked at how the clock gets wound up, tracking the complex circulation of money or commodities.
But here in Volume 3, the text finally turns the clock back around to look at the face.
It looks at the capitalist system exactly as it appears on the surface of society. I mean, we are finally dealing with the things we actually experience in our daily lives.
Market competition, stock market, interest rates.
Exactly. Rent, corporate dividends, and the everyday consciousness of the people operating within the system.
But, and this is the massive caveat that drives the entire book, the text argues that the face of this clock is heavily disguised.
It plays tricks on the observer.
Right. What you see on the surface is absolutely not the reality of the hidden gears. In fact, the surface actively conceals how the machine actually operates.
So we have to unpack this disguise. We need to bridge the gap between those hidden mechanics and the surface reality.
And to do that, we have to start with the most basic metric of business, which is profit.
Right. In the earlier volumes, the theoretical framework establishes that all new value comes from human labor.
But when we look at the real world, we don't see, like, labor value on a corporate balance sheet. We see profit.
And this transformation, the shift from value to profit, is the subject of the entire first section of the book.
Okay.
It's about how surplus value, which in this theoretical framework is the unpaid labor extracted from the worker, is transformed into what everyday society calls profit.
So how does that happen?
To grasp this, you have to put yourself entirely in the perspective of the capitalist, the business owner. When a business owner starts a company, they don't look at value as purely a function of labor.
Right. They look at the total amount of capital they have to advance to get the business running.
Exactly.
Let's use a tangible example here. Say I am opening a mid-sized manufacturing firm. I have to buy two very different things, right? First, I buy the building, the conveyor belts, the robotic arms, the raw steel.
Right. The text calls this constant capital.
Okay. Then I have to hire the workforce to actually operate the plant. And the text calls the money I spend on their wages variable capital.
Those two categories are crucial. Constant capital, the machines and materials, and variable capital, the human labor.
Got it.
Now, at the end of the production cycle, you sell your manufactured goods and you make a surplus. You have more money than you started with.
Awesome.
From your perspective as the business owner, where did that surplus come from?
Well, from my perspective, it came from my entire investment. I mean, I laid out $10 million total, maybe $8 million in the factory and $2 million on payroll.
Right.
The entire $10 million was at risk. The entire $10 million was necessary to make the product. So when I calculate my rate of return, I just look at the profit I made relative to the total $10 million I advanced.
Because why wouldn't you?
Exactly. Why wouldn't I? Why does the text insist that this completely logical business perspective is actually an illusion?
Because it fundamentally misunderstands the physical reality of what creates new wealth, at least according to the labor theory of value.
Okay, unpack that.
The text argues that your machines and raw materials, your constant capital, they do not possess the magic ability to create new value out of thin air.
But they make the product.
They do. Think about your robotic arm, though.
Yeah.
That robot has a specific value based on the labor it took to engineer and build it, right?
Yeah.
As it operates on your assembly line, it slowly wears out. Its joints degrade, its motors burn out over time. What it is actually doing in this framework is just slowly transferring its existing value into the products it helps make.
Oh, I see.
It transfers value, but it doesn't expand it. It doesn't add a single drop of new value beyond what it already contains.
So if a machine costs $100,000 and lasts for 10,000 hours of production, it just sort of drips $10 of its own pre-existing value into the product every hour until it dies.
Precisely. Only living human labor, the variable capital, has the unique physiological and social capacity to generate more value than it costs to maintain. You pay a worker a daily wage that covers their basic survival, like food, rent, clothing. But the worker might produce enough value to cover that daily wage in just 4 hours of work.
Right.
The next 4 hours of their shift, they're creating purely new surplus value that you, the owner, appropriate.
But as the business owner, I don't see that dividing line. I don't segregate the robotic arm from the human operator in my final profit calculation.
No, you don't.
I just look at my total cost price, like the aggregate amount I spend on everything.
And that aggregate view is exactly where the illusion takes hold. Because the capitalist measures their surplus against their entire investment, the specific, unique, value-creating role of the human labor is completely obscured.
Wow.
The surplus value puts on a disguise. It emerges on the surface of society as profit, which appears to be the natural offspring of the total capital advanced.
Right. The capitalist looks at their spreadsheet and says, my money generated this return.
Completely erasing the human exertion that the text argues is the actual physical source of the new wealth.
Okay, I track the logic of the disguise. But this leads to a massive, glaring theoretical paradox. I mean, in fact, this paradox is so huge that it completely stumped earlier classical economists like David Ricardo.
It really did.
And it threatened to tear the whole labor theory of value apart.
We are talking about the problem of the average rate of profit.
Yeah. Let me set up the paradox for the listener, because once you see it, it seems like a fatal flaw in the whole framework.
Go for it.
If we accept the premise that only human labor, the variable capital, creates new surplus value, we run into a brick wall when we look at the real world. But let's compare two different industries.
Okay.
Industry A is a state-of-the-art chemical refinery. It is heavily automated. You have hundreds of millions of dollars invested in giant steel vats, piping, computer systems, so massive constant capital.
Right.
But you only need a dozen technicians in a control room to run it, so very tiny variable capital.
A very high organic composition of capital in the terminology of the text.
Exactly. Now, compare that to Industry B, which is a massive commercial laundry facility.
Okay.
They use relatively cheap washing machines, so low constant capital, but they employ 500 people to sort, fold, and press the clothes. Massive variable capital.
So we have Industry A with almost no workers and Industry B with hundreds of workers.
Here is the paradox. If only the workers create surplus value, then Industry B, with its army of 500 laborers, should be generating astronomically higher rates of profit than the chemical refinery with its 12 guys in a control room.
Mathematically, yes, it should.
But if you look at the real global economy, that isn't what happens at all. Different industries, regardless of whether they are highly automated or highly labor-intensive, tend to yield roughly the same average rate of profit over time.
Right.
So if the labor theory of value is true, how is this leveling out even mathematically possible?
And this is where Engels had to do some of his most complex editorial work, reconstructing Marx's solution to this exact problem, which is often called the transformation problem.
How does the text resolve it?
The text resolves this apparent fatal flaw by introducing a dynamic, system-wide mechanism. It's the formation of the general rate of profit through the relentless mobility of capital.
Walk me through the mechanics of that mobility. How does the profit level out?
Well, you have to stop looking at individual factories in isolation and look at the capitalist system as a fluid, interconnected whole.
Okay.
Capital is not static. It constantly sloshes around the economy, aggressively hunting for the highest possible return.
Right.
Let's go back to your example. Initially, based purely on labor value, the commercial laundry, Industry B, is actually extracting a larger mass of surplus value relative to its total investment.
Because of all the workers.
Exactly. Because of that, its profit margins temporarily spike above the social average.
And in a competitive market, a spike in profit margins is like blood in the water.
Exactly. Capitalists in other less profitable sectors, maybe even the chemical plant owners, see those massive returns in the commercial laundry business. They want a piece of that action. So they divert their capital. They start building new commercial laundries. But as capital floods into Industry B, production rapidly expands. The supply of laundry services skyrockets.
And what happens when supply vastly outstrips demand? The prices get driven down? I mean, they have to cut prices to compete with all the new laundries.
Yes. The intense competition forces the price of laundry services down. Meanwhile, what is happening back in the chemical sector?
Capital has drained out of it.
Right. Factories might close or expansion halts. The supply of chemicals drops, which means the remaining chemical plants can raise their prices.
Oh, wow.
This relentless migration of capital, flooding into high-profit sectors and driving prices down, draining out of low-profit sectors and driving prices up, acts as a giant societal equalization mechanism.
I really want to introduce an analogy here because this is a heavy concept. Think of the entire global economy as a series of different shaped water tanks connected by a network of pipes at the bottom.
I like this.
Each tank is a different industry. The water inside is the capital. If you pour a ton of water into one tank, which represents a spike in surplus value in a labor-heavy industry, the water doesn't just stay piled up in that one tank.
Right.
Because of the connecting pipes, which represent the credit system, the stock market, and market competition, the water immediately flows out of the high tank and into the lower tanks until the water level in every single tank is exactly equal.
That is a brilliant way to visualize it. That equalized water level is the general rate of profit.
Right.
And the implication of this is earth-shattering for economic theory. It means that commodities do not actually sell at their true value, meaning they don't sell for a price that directly reflects the exact amount of labor time embedded in them.
Because of the sloshing water tanks.
Because of the sloshing water tanks, commodities sell at what the text calls prices of production.
Which is just the cost price of making the thing, plus this average leveled out profit rate.
Exactly. And the profound conclusion here is a mechanism of literal value transfer.
What do you mean?
Well, the high-tech, highly automated industries, the chemical plants, are mathematically incapable of generating enough surplus value from their tiny workforces to justify their massive capital investments.
Right.
So to achieve the average profit rate, they are literally siphoning off surplus value that was generated by the heavily exploited workers in the labor-intensive industries.
So the tech startup with 50 employees and a billion-dollar valuation is effectively subsidizing its profit margins by indirectly extracting value from the thousands of garment workers in an entirely different sector, just through the mechanics of global market pricing.
Yes. The text reveals that capitalists aren't just exploiting their own specific workforce in a vacuum. They are functioning as a giant, collective, fraternal class.
Wow.
All the surplus value extracted from all the workers in all the industries globally goes into one massive societal pool.
And then they just divide it up.
Right. And then the capitalists divide that pool amongst themselves, not based on how many workers they personally employ, but strictly based on the size of the total capital they invested. It's a mechanism of collective class appropriation.
If you are listening to this and thinking about modern investing, this maps perfectly onto how we view the global market.
It really does.
When you invest your 401k into an S&P 500 index fund, you don't expect the service companies to yield 1,000% more profit than the highly automated tech giants, even though the service companies employ vastly more human beings.
Exactly. You expect a generally leveled playing field of returns relative to risk.
Because the global market is constantly sloshing your investment around, chasing that average water level. This text in 1894 was mapping out the literal DNA of how modern global investment portfolios operate.
But the analysis doesn't stop there, because once you understand this massive equalization mechanism, you have to ask the next logical question.
Which is?
What happens to that average water level over a long period of time as society progresses and technology advances?
Right.
And this brings us to one of the most famous, controversial, and hotly debated arguments in the entire work.
The law of the tendency of the rate of profit to fall. I'll admit, the first time I encountered this concept, it sounded entirely counterintuitive.
It does to a lot of people.
I mean, we live in a world where capitalism seems incredibly, astoundingly profitable. Tech companies post record billions in profit every quarter. But the text argues there is a core, unavoidable contradiction slowly eating away at the foundations of the system.
It's a contradiction born from the very nature of capitalist competition. And it goes right back to that distinction between constant capital, the machines, and variable capital, the human labor.
Yeah.
Think about how businesses actually compete. They don't usually compete by just asking their workers nicely to work twice as fast.
No. They compete by trying to produce commodities faster and cheaper than their rivals.
And the primary way you do that is through technological innovation. You buy a better machine. You automate the assembly line. You implement AI software.
Exactly. You invest massive amounts of money into constant capital.
But here's the catch. As your factory becomes more automated, the machines are doing more of the physical production. Therefore, you need relatively fewer human workers to operate those machines.
Right.
The ratio of your investment changes. You are spending vastly more on constant capital and relatively less on variable capital.
Let's expand on this with a thought experiment. Imagine you own a factory making shoes. For years, you've had 100 workers at manual sewing machines.
Okay.
But then you buy a revolutionary new robotic assembly line. It can make shoes 3 times as fast, and you only need 10 workers to monitor it.
Right.
For a brief, glorious window, you are making incredible super profits. You are producing shoes far cheaper than the social average, but selling them near the average market price. You are crushing your competitors.
But that window is inherently temporary, because what is the rational response of your competitors?
They have to buy the exact same robotic assembly line, or they go bankrupt.
Right. And once the entire shoe industry adopts this new technology, the social average changes. The price of shoes plummets across the entire market because they take drastically less labor time to produce.
And the super profit vanishes.
I like that.
And now the entire industry is trapped on a technological treadmill. Look at what just happened to the baseline structure of the business.
Right.
The whole shoe industry now has massive, expensive machinery costs.
Right.
The denominator in their profit calculation, the total capital advanced, has exploded. But the numerator, the surplus value, is entirely dependent on human labor. And they just fired 90% of their workforce.
Yeah.
If human labor is the only source of new surplus value, And the relative number of humans in the production process is constantly shrinking compared to the giant mountains of technological investment.
Then the overall rate of profit, the mathematical ratio of the surplus value divided by the massive total investment, must logically trend downward over time. It's a mathematical certainty within this framework. The capitalists are forced to run faster and faster on that treadmill, investing larger and larger sums of money into technology just to maintain the same massive profit, all while the rate of return on that massive investment slowly suffocates.
It's a breathtaking claim.
Hmm.
The argument is that the very mechanism that drives capitalism forward, relentless technological innovation, increased productivity, the development of human productive capacity, is the exact same mechanism that inevitably squeezes its profit margins to death.
It is. But we have to be very careful here, and the text itself is incredibly careful. It explicitly calls this a tendency, not an absolute, straight, uninterrupted line into immediate collapse.
Right.
It describes it as an underlying gravitational pull. And just as airplanes can fly by using aerodynamics to counteract gravity, capitalists constantly fight back against this falling rate of profit.
So they don't just accept it.
No, of course not. The text outlines several specific counteracting influences that can temporarily stall or even reverse the fall.
Let's dive deep into some of those counteracting influences, because this is where the text feels like it was written yesterday. The first major one it mentions is increasing the intensity of exploitation.
Right.
If your overall profit rate is shrinking because you have fewer workers relative to your machines, how do you fix it? You squeeze the absolute maximum out of the workers you still have left.
Yes. You increase the absolute surplus value by lengthening the working day without increasing pay. Or, more commonly in advanced tech economies, you increase the relative surplus value by speeding up the intensity of the work.
Oh yeah, like tracking software.
Exactly. You use software to track a warehouse worker's every footstep to ensure they don't stop moving for a single second. You make the work mentally and physically exhausting so that the worker produces more value in the same 8-hour shift than they used to.
Another incredibly relevant counteracting method the text notes is depressing wages below their actual value.
Yeah, that's a big one.
You find ways to pay people less than what it actually costs for them to physically and socially reproduce their labor power. You rely on gig economies, precarious contracts, or you force workers to rely on debt to cover their basic living expenses, thereby artificially inflating your profit margin at the expense of their survival.
And then there is a highly technical but crucial counteracting factor, which is the cheapening of the elements of constant capital.
Walk us through how that works mathematically.
Well, remember that the falling rate of profit is caused by the cost of machinery, the constant capital growing much faster than the cost of labor.
Right.
But the very technological advances that cause this problem also make it cheaper to produce the machines themselves.
Oh, right.
As manufacturing gets more efficient, the robotic arms, the computer chips, and the raw materials actually drop in price.
So while the physical volume of machinery in a factory might increase tenfold, the monetary value of that machinery might only double.
Exactly. This acts as a massive brake on the falling rate of profit, because the denominator in your profit equation doesn't grow nearly as fast as it otherwise would.
The system essentially relies on its own efficiency to stave off its own crisis.
Yeah.
But there's one more counteracting influence that we have to discuss,
Right.
because it essentially explains the geopolitical history of the 20th century.
Foreign trade.
Yes, foreign trade and the expansion of the world market.
This is a massive point in the text. When the profit rate in an advanced, highly industrialized country starts to choke because the organic composition of capital is too high, too many machines, not enough exploitable labor, capital is forced to look outward.
It is a structural imperative.
It is.
It has to find a new water tank where the water level of profit is higher.
Exactly. They expand into foreign markets. They do this for two reasons. First, to get cheaper raw materials, which cheapens their constant capital. But more importantly, they seek out less developed economies where the organic composition of capital is still low, where there is very little machinery and a massive untapped pool of cheap human labor.
Okay.
By investing capital there, they can extract a much higher rate of surplus value and funnel those super profits back into the general global pool, raising the average rate of profit for the advanced nations.
The text is explicitly outlining the structural economic imperative behind colonialism, imperialism, and modern globalized supply chains. It's not just a political choice to go abroad. It is a desperate economic necessity to escape the suffocating profit margins at home.
Completely.
If you are listening to this and thinking about why your smartphone is designed in a high-tech campus in California but assembled by hand in a massive factory across the world, you are looking directly at the counteracting influences to the falling rate of profit in action.
But even with all these counteracting forces, the text argues the underlying tendency ultimately persists. The gravity is always there.
Right.
And this relentless pressure creates a fascinating, highly volatile situation that the text calls excess capital and excess population.
I found this concept incredibly compelling. What exactly does excess capital mean? It sounds like an oxymoron. How can a capitalist ever have too much capital? Isn't the goal to have as much as possible?
It's an oxymoron only if you think of capital just as money sitting in a vault.
Okay.
But capital must be in motion. It must be invested to create more value. Excess capital means that you have accumulated a massive hoard of wealth that you desperately want to invest, but because the average industrial profit rate has been driven so low by technological advancement, you literally cannot find a profitable place to put it in the real physical economy.
Because building another shoe factory or another steel mill just isn't worth the risk anymore. The margins are too thin.
Exactly. So you have massive pools of idle money. And at the same time, because of that very same automation, you have an excess population of workers who have been replaced by machines and can't find employment.
So you have idle money on one side and idle hands on the other.
Precisely. And they cannot be brought together because doing so wouldn't yield a sufficient profit rate for the capitalist.
So what does that massive pool of idle, frustrated capital do? It can't just sit there.
Right, it can't. The text argues that this excess capital is violently pushed out of the physical production process and down what it calls the adventurous road of speculation, credit frauds, stock swindles, and crises.
And just like that, we transition from the gritty reality of the factory floor into the massive, abstract world of Section 5 of the text. The very section that gave Engels so many headaches.
Because industrial profit margins are constantly under threat from the technological treadmill, the capitalist system has to invent an escape hatch.
It has to mutate. We are entering the realm of finance, banking, and the birth of what the text calls fictitious capital.
This is where the analysis becomes frighteningly prescient. Up until this point in the book, we've mostly been dealing with industrial capital. Money used to buy physical machines and human labor to make a tangible product.
Right.
But when that physical production becomes less profitable, capital transforms into interest-bearing capital. In this form, capital itself becomes a commodity.
Let's break down how bizarre this actually is when you think about it. A commercial bank or a moneylender doesn't buy machines. They don't hire workers to build things. They just rent out money.
Right. But they aren't loaning it out simply as a neutral medium of exchange, like when you borrow $10 from a friend to buy lunch.
No.
They are loaning it out as self-expanding value. The borrower takes the money, acts as the industrial capitalist, uses it to exploit labor and make a profit in the real economy, and then returns the original sum to the lender, plus a cut of the surplus value, which we call interest.
The language the text uses to describe this process is incredibly evocative, almost gothic.
Oh, it really is.
It points out that in the form of interest-bearing capital, the money seems to yield interest purely by its own inherent nature. The quote from the text is that it produces interest much as it is an attribute of pear trees to bear pears. It's as if the money in the bank vault is biologically reproducing in the dark.
It's the ultimate fetishism. And Marx uses a very specific, terrifying metaphor for this system. He calls interest-bearing capital a Moloch.
Moloch being the ancient deity associated with child sacrifice.
Exactly. It's a striking image for a financial system that claims ownership over, quote, all surplus labor which the human race can ever perform.
Because the creditor, the financier, gets the very first cut of the wealth generated by human exertion.
Exactly. Completely bypassing the messy physical reality of the actual production process. They just sit back and watch the numbers go up.
Now, I have to push back here on behalf of modern economics. Isn't this entirely necessary? I mean, you can't build modern civilization out of a piggy bank.
Of course not.
You cannot build a massive transcontinental railway or a global shipping fleet or a telecommunications network purely out of pocket. Credit allows society to pool its resources. It accelerates development. Surely the text recognizes that credit is a powerful tool for human advancement.
It absolutely does. This is a crucial point that often gets lost in reductive readings of Marx. The text does not view credit as simply an evil conspiracy.
Okay, good.
It entirely agrees that credit is the motor of massive historical development. It explicitly notes that credit breaks down the barriers of individual private wealth. It allows for stupendous, rapid development of the productive forces.
So without the credit system, capitalism couldn't have achieved a fraction of the technological wonders it has.
Not at all.
So where is the problem?
The problem is the inherent contradiction of what credit actually represents. While it drives massive development, it also acts as the main lever of overproduction and catastrophic overspeculation.
Why?
Because credit allows you to produce based not on current reality, but on future expectations.
Ah, you are spending money today based on the assumption that the market will be there to buy the product tomorrow.
Exactly. Credit acts like an elastic band that stretches the economy far beyond its actual physical limits of consumption. The physical limits of the market are ignored because the credit system creates artificial demand. But eventually, that elastic band snaps.
And then what?
The future expectations don't materialize, the commodities can't be sold at a profit, the debts can't be repaid, and you get a massive systemic financial crisis.
Which leads us directly into the most fascinating and arguably most relevant concept in the entire book for a modern listener.
Yeah.
Fictitious capital.
Yes.
If you have ever looked at the stock market and felt a deep sense of unreality, this is the theory that explains exactly what you are feeling. What is fictitious capital?
Fictitious capital refers to financial instruments, things like stocks, government bonds, and complex securities.
Okay.
The text argues that despite how they appear on a balance sheet, these are not real capital. They do not represent existing physical wealth functioning in the production process.
Then what are they?
They are merely titles of ownership or paper drafts on future surplus value.
Let's use a highly detailed real-world example to make the mechanics of this concrete, because it is essential to understand. Let's say a railroad company needs to build a new track across the country. They issue a bond to raise the money.
Right.
You, the investor, buy that bond for $10,000.
Okay, let's track the reality of that $10,000. The railroad company takes your real money and they spend it. They buy steel rails, they buy timber, and they pay wages to the workers laying the track.
Got it.
That real capital is now gone. It has been completely consumed in the physical production process of building the railroad.
But wait, I still have my bond. My portfolio says I have $10,000 in assets. It feels incredibly real to me. I could even sell that bond to someone else tomorrow.
It feels real, and it functions as a tradable asset, but the text insists it is an illusion of capital. The actual physical capital, the steel and the labor, has already been expended.
So what do I have?
What you are holding in your hand is just a piece of paper. That piece of paper is a legally enforceable claim on a portion of the railroad's future profits. You are trading a paper claim on wealth that hasn't even been created yet.
And the same logic applies to the stock market. When you buy a share of stock on the secondary market, say you buy a share of a massive tech company on your phone right now, you aren't actually giving money to that company to help them build a new data center.
No.
The data center is already built. The company doesn't see a dime of your transaction. You are just buying the right to a future dividend from the person who previously held that right.
Exactly.
Or, more likely, you are just betting that someone else will be willing to pay you even more for that paper right tomorrow.
Precisely. And this is where the text introduces a brilliant analysis of joint stock companies, which are what we call modern corporations.
Right.
At the time Marx was writing, and certainly when Engels was editing in the 1890s, the corporation was becoming the dominant form of business. The text views the corporation as a deeply contradictory transitional phase in human history.
Because it completely severs the traditional role of the capitalist. In a corporation, the function of capital, actually running the factory, managing the workers, overseeing production, becomes totally separated from the ownership of the capital.
Yes. The traditional industrial capitalist, the guy in the top hat walking the factory floor, becomes obsolete.
Right.
The actual management is handed over to salaried managers and executives. The owners are now just a dispersed sea of shareholders sitting hundreds or thousands of miles away, completely disconnected from the physical reality of the production process, merely collecting dividends based on their paper claims.
The text argues that this separation creates a new aristocracy of finance. It generates an entire systemic architecture of what it calls parasitic swindling and gambling on the stock exchange.
And why is that?
Because the valuation of these stocks is based almost entirely on subjective future expectations rather than current physical realities. The paper wealth of the stock market can wildly, violently detach from the actual physical assets or the current profitability of the companies.
And that detachment is the essence of fictitious capital. The valuation of the paper becomes a self-fulfilling prophecy driven by speculation, credit leverage, and market psychology, completely untethered from the hidden gears of human labor that actually keep society running.
I really want you, the listener, to pause and map this onto today's financial markets. We see this unreality every single day. We see a tech company that has never turned a single dollar of actual profit, yet it is valued on the stock market at $40 billion.
It happens all the time.
We see a rumor on a social media platform wipe out half of a company's market capitalization in an hour, evaporating billions of dollars of quote-unquote wealth without a single machine in their factories changing how it operates or a single worker stopping their shift.
Right.
The physical reality of the company and the paper reality of its stock valuation are existing in two completely separate universes. The source text we are discussing today was dissecting the exact DNA of this phenomenon over a century ago.
It is analyzing a system that is constantly, desperately abstracting itself away from the physical limitations of human labor and physical materials.
Right.
But that abstraction requires a powerful ideological justification. The people living inside this system have to believe that the abstraction is actually the natural order of the universe.
And that brings us to the final sweeping philosophical critique of the book.
Yes, it does.
Right. We have traveled a massive distance. We started on the sweaty, noisy factory floor where surplus value is extracted. We watched that value get pooled and leveled out through market competition.
Yeah.
We saw how the technological treadmill forces the profit rate down, which pushes capital to mutate into interest-bearing loans and wild stock market speculation. Now, in Section 4, we examine how this entire complex, layered, deeply unstable system is perceived by the everyday person walking down the street.
And frankly, by the mainstream economists who defend it.
Exactly.
The text calls this perception the Trinity formula, and it views this formula as the ultimate crowning mystification of the capitalist system. It is the final, perfect disguise that makes the whole topsy-turvy world seem entirely rational.
Okay, let's unpack this Trinity formula. What are the three parts of the Trinity?
The formula is the universally accepted idea that capital produces profit, or interest, land produces rent, and labor produces wages.
Okay.
This was the foundational wisdom of classical political economy, and if you think about it, it's basically how almost everyone still views the economy today. Three different independent factors of production, each naturally and inherently producing its own specific form of income for its owner.
Capital gives you profit, land gives you rent, labor gives you wages. It sounds perfectly neat, symmetrical, and logical. So why does the text spend so much time tearing this formula apart? Why is it a problem?
Because, the text argues, putting these three things together in a single formula is a profound logical fallacy. It compares combining capital, land, and labor to combining, quote, lawyers' fees, red beets, and music.
Lawyers' fees, red beets, and music. They are utterly incommensurable. They don't belong in the same category of existence.
Exactly. You are taking things that exist on completely different logical and physical planes and treating them as if they are identical wellsprings of value.
Let's break that down.
Okay, let's break the three down based on everything we've discussed.
Yeah.
First, capital. As the text has painstakingly argued across three massive volumes, capital is not just a pile of machines or a stack of money. A robotic arm on a deserted island is not capital.
Right.
Capital is a specific, historically temporary social relation. It's a system where one specific class monopolizes the means of production, forcing another class to sell their labor to survive.
Okay, so capital is a social relation. What about land?
Land is a physical element of nature. It's dirt, minerals, water, sunlight. It exists completely independent of human history.
Right.
And finally, labor. Labor is human exertion, a biological and physiological process of interacting with nature to shape it for our needs.
So, the Trinity formula takes a historically specific social relation, which is capital, a raw physical object of nature, which is land, and a biological human activity, labor, and treats them as if they are three identical magical geysers that just naturally spray wealth into the air.
Yes. And by doing so, it completely severs the connection to the actual physical source of all new value, which is human labor interacting with nature.
It's all hidden.
Exactly. Under the Trinity formula, social relations are converted into mere objects, and objects are given social agency.
This is where we get to the concept of reification, right?
Right. And it produces one of the most brilliant, haunting, and famous quotes in the entire text. It describes capitalism, when viewed through the lens of this formula, as an enchanted, perverted, topsy-turvy world in which Monsieur le Capital and Madame la Terre do their ghost-walking as social characters.
Monsieur le Capital and Madame la Terre, Mr. Capital and Mrs. Land. It's personifying the inanimate, and it's incredible how deeply, invisibly embedded this exact ghost walking is in our language and our culture today.
Oh, we do it all the time.
We don't even notice we are doing it. We literally say things like, let your money work for you, as if a $100 bill is putting on a tiny hard hat, grabbing a lunchbox, and going down into a coal mine to dig up more dollars.
Right.
We personify the capital, just as the text says. We treat the money as if it has independent biological agency.
We do. And simultaneously, we commit the opposite crime. We objectify the human being. The living, breathing worker is stripped of their agency and just becomes a labor cost.
Just a line item.
Exactly. A sterile line item on a corporate spreadsheet, conceptually no different than the cost of electricity, lubricants, or raw materials. The things become people, and the people become things. The subject becomes the object.
That is the ghost walking.
That is it. The system appears haunted by its own creations.
This is a devastating philosophical critique, but I want to ask about the practical application. Why does this matter? Is this just an academic complaint about sloppy language and categories? Or is there a functional systemic purpose to this grand illusion?
Oh, it is highly functional. In fact, it is the ideological glue that holds the entire system together.
Really?
Yes. The text claims that this religion of everyday life serves the ruling classes absolutely perfectly. By accepting the Trinity formula, society elevates the sources of revenue for the wealthy to an unquestionable dogma. It makes the current distribution of wealth seem like a physical necessity, an eternal, unbreakable law of nature.
Ah, I see it. If capital naturally produces profit, just by its very existence, the same way a pear tree produces pears, then you can't argue with it.
Exactly.
You can't unionize against a pear tree. You can't legislate against the laws of physics.
Precisely. It completely masks the fact that capitalism is a historically specific, temporary social structure built on a foundation of exploited labor.
It hides the hidden gears.
When you look at the face of the clock through the lens of the Trinity formula, you just see the hands moving according to seemingly natural mathematical laws. You don't see the tension of the springs, you don't see the friction of the gears, and you certainly don't see the human sweat that wound the whole mechanism up in the first place.
Okay, let's pull all of this together, because we have gone on a massive, complex journey through the architecture of this text today. We started by exploring the great disguise, how the specific surplus value extracted from living workers is masked as profit by being measured against the capitalist total investment.
Right.
We watched as the global market sloshed that capital around, equalizing the profit rates and transferring value from labor-heavy industries to high-tech ones. We dissected the core contradiction, how the relentless competitive drive for better technology and automation ironically pushes the overall rate of profit down, forcing capitalists to run ever faster on a technological treadmill.
And we saw how the system desperately tries to escape that falling profit rate by mutating. It explodes into the realm of credit, banking, and fictitious capital, where paper claims on future wealth violently detach from the physical reality of production.
And finally, we explored how the Trinity formula blinds society to all of this instability, leaving us in a topsy-turvy ghost walk where money seems to work and humans are reduced to mere costs.
It is, without a doubt, one of the most comprehensive, sweeping critiques of an entire systemic architecture ever written. And regardless of your political leanings, it leaves us with a tremendous amount to unpack about the reality we are living in right now.
It really does. And to that end, I want to leave the listener with a final provocative thought to mull over, something that builds directly on a very surprising claim in the text.
Okay.
You mentioned earlier when we were talking about joint stock companies and corporations that the text views this as a transitional phase. Can you expand on that? What exactly did Marx and Engels think this massive financialization was transitioning towards?
This is perhaps the most surprising and dialectical element of Volume 3. Marx and Engels didn't just view the credit system and the rise of massive stock companies as a parasitic evil.
What did they think it was?
They suggested that these institutions actually represent the latent abolition of capitalist property occurring within the boundaries of capitalist production itself.
Wait, capitalism is actively abolishing itself from the inside out. How does that work?
Think about what a massive modern global corporation actually is. The production process itself is entirely beautifully socialized. You have thousands of workers, managers, logistics experts, and engineers cooperating across dozens of countries to build a single product.
Right.
The capital itself is also completely socialized. It is pooled from millions of individual retail investors, massive pension funds, and global banks through the immense network of the credit system. Production is social, capital is social. The only thing that remains private in this entire sprawling architecture is the appropriation of the final profit.
The people who hold the paper shares get the money, but they have absolutely nothing to do with the actual miraculous socialized production process that created the wealth.
Exactly. The capitalist, as an active, necessary manager of production, is gone. They've rendered themselves obsolete, replaced by salaried managers.
Just collecting passive income.
They are now just passive shareholders clipping coupons. The text argues that this represents the absolute ultimate limit of the capitalist mode of production. It has pushed the socialization of human labor and resources to its maximum extreme, but it is still wearing the increasingly restrictive, contradictory mask of private ownership. The shell is ready to crack.
Which brings us to our final question for you, the listener. We live in a world dominated by this exact dynamic.
We really do.
If the modern stock market and the sprawling global credit system represent the absolute limit of this mode of production, if we are living in a system that is increasingly relying on fictitious paper claims to the future rather than real, profitable physical industrial production in the present, is the towering, complex architecture of global finance actually slowly dissolving the very foundations of the system it was built to protect? Is the parasite finally eating the host?
It's a question that forces you to look past the surface, past the daily fluctuations, and examine the deep structural tension of the world we've built.
Think about that next time you log in to check your 401k or the next time you watch a stock ticker scrolling green and red across your screen. Are you looking at a reflection of the real physical economy, or are you just staring at the face of a clock, mesmerized by the hands moving, completely unaware of the massive, unsustainable tension building in the hidden gears beneath?